What is going on, guys? Today we're going to be talking about three fast-growing industries. We're going to be talking about cybersecurity, renewable energy, and fintech. All three of these industries are growing at a CAGR of over 15%. CAGR, compounded annual growth. First things first, we're going to be talking about renewable energy. Renewable energy industry is growing at a 17% year-over-year compounded growth, projected to grow 17% until 2030. And we can see this graph outstanding. So solar power is the largest segment in the renewable energy segment. It has a market share of 30% in 2023, and not too long ago, it was much smaller than this. So another big thing to make sure you understand is that renewable energy isn't just growing in the US. Renewable energy is growing around the whole world globally. And Asia makes up 40% of the renewable energy segment. And China has the largest energy demand out of all the countries, and India is growing as well. And all of these countries are moving towards renewable energy. So that's why I chose Brookfield Corporation as the perfect stock to benefit and reap all these rewards of this growing industry. So Warren Buffett, what I love about Brookfield Corporation, it is such a shareholder-friendly stock. They have, for the last 30 years, they have a track record of growing over 15%, of giving over 15% of annualized returns to shareholders. These guys pay dividends, these guys buy back shares, and the best thing is these guys are very adaptive. And they do invest in mostly boring stocks. They have three segments of the business: asset management, wealth solutions, and operating business. Operating business, the one we're going to be talking about today is renewable energy. They also own real estate. They also own insurance businesses, but that's not what we're going to be talking about today. Why I recommend investing into Brookfield rather than the other solar companies, and because the solar companies that most people invest to are only based in America, and Brookfield is is across 5 continents, managing a diverse portfolio of hydro, wind, solar, distributed energy, storage, and sustainable solutions. These guys are also getting into nuclear energy. So let's get right into it. Key highlights of the recent quarter. So far this year, Berkshire Renewable Energy has deployed or committed to deploy $8.6 billion of capital into multiple investments globally for the renewable energy. It has also announced a partnership with Microsoft to deliver 10,000 megawatts of renewable energy capacity from 2026 to 2030. So their current capacity is 34,000 megawatts. So this is going to be a third. This is a third of their current generating capacity, 10,000 megawatts. We can see that they have a very strong balance sheet, 4.4 billion of liquidity, providing significant flexibility to continue investing in growth and development. We can see here this year advanced initiatives that are expected to generate approximately 3 billion of total proceeds. Only 1.3 billion is net to Brookfield Renewable. If you think 34,000 megawatts is a lot, wait till you see this. So their development pipeline stands at approximately 200,000 megawatts. So in the future, they will have over 200,000 megawatts of generating capacity. How did they get this energy? Hydroelectric, wind, utility scale solar, storage facilities in North America, South America, Europe, and Asia. Another big thing that I really like is their investment in Westinghouse, a leading global nuclear service business. So they're also investing in nuclear energy, which I believe is a big part of the future that we're not going to get into too much in this video. It's not going to be a deep dive. So comment below if you want a deep dive in this stock. And boom, look at this. So Berkshire Renewable is a flagship listed renewable power and transition company of Brookfield Asset Management. Brookfield Asset Management is a BAM, and it has its own ticker symbol. It has its own publicly traded stock. And BAM has over 925 billion of assets under management. So Brookfield is investing in the future. And we can see that this quarter, we awarded a 20-year capacity contracts for 400 megawatts of battery storage with the First Nations partner. 20-year capacity contract. I've never seen companies talk about a 20-year deal, especially not these small solar ones. That's why I'm so bullish on Brookshire. So we can see that they also made an acquisition of Neoen, and now they'll be one of the largest battery developers globally with 2,300 megawatts of operating and under construction capacity. Now, BEP, Brookfield Renewable Energy Partners, that is the stock we have been talking about. They do pay a nice 6% dividend and have been performing pretty nice, up 176% since 2004. We can see that BAM, Brookfield Asset Management, owns 25% of the company's publicly traded shares. And BAM is a big position in my portfolio, and I will reap the benefits of the renewable energy segment through BAM as well. And the main thing, and I believe the best stock to buy right now to benefit of all of this, is BN Brookfield Corp. So this is the main business. This is the mother of the business. So all of these smaller businesses like insurance and renewable energy are all compacted in Brookfield Corp. So these guys pay a very small dividend and are trading at a pretty cheap stats. I will not do a deep dive. If you want a deep dive, go check out Daniel Pronk's video. As an individual stock picker, my main goal is to beat the market, to beat the SPY, to beat the top 500 companies listed in the US. And we can see right here that if you invested in BN, you have outdone the market dramatically. Since 2004, BN is up 5,000%, 5,300%, while the SPY is only up 392%. If you're interested in investing in BN, I highly encourage you to go check out Daniel Prunk's videos. He has a bunch of videos in Brookfield, and Brookfield is his largest position in his stock portfolio as well. Rapidly moving on. The next industry is fintech. That's what we're going to be talking about. So current revenues in 2024, fintech has generated $245 billion worth of revenue. By 2030, they're projected to generate $1.5 trillion in revenue. That's a six-fold. So every year, the global financial services brings in $12.5 trillion of revenue. Currently, fintech only holds a 2% market share, and it is estimated to grow to 7% by 2030. Or actually, I'm sorry, banking fintechs are expected to continue to constitute almost 25% of all banking valuations worldwide by 2030. 25%, that's massive. So just like renewable energy, fintech isn't just growing in the US, it is growing globally. And again, the fastest growth is in China. China is expected to grow at a CAGR, compounded annual growth, of 27%. So these are the emerging markets, China, India, Indonesia, etc., that are growing a lot faster than the US. But don't count out the US. The US is still growing at a CAGR of 17%, which is pretty damn good. So looking at this blog, we can see that from 2019 to 2023, the market cap of all the fintech stocks combined has 2x. They have 2x increased. We can also see that venture capital, it is growing. A lot more venture capitalists are investing into fintech stocks. So how can we benefit off this growing industry, and what stocks are the best to buy in this growing industry? That's going to be hard to say because, like we said, China is growing at a 27 CAGR. And to invest in China, there's two stocks that I have already covered on my channel, FINV and QFIN. I will leave a link below on the video where I went over those two stocks, which do pay a nice dividend, very healthy balance sheet, and very nice growth. And one of the companies, FINV, isn't just in China, they're also growing in Philippines, Indonesia, and other countries. But the stock we're going to be going over today, and the stock I've already talked about on the channel a lot, and I'm sure you guys are familiar with, is SOFI. So SOFI is the one-stop shop. With SOFI, you can get all your financial services done, everything you need, from credit cards, mortgages, personal loans, student loans, insurance, investing, TFSA, you can invest in crypto, you can do everything with SOFI. And if we take a quick look at the SOFI's Q2 presentation, we can see that they have just been growing and growing and growing, adding more and more members. And like we said, SOFI is a one-stop shop. So when somebody becomes a member and uses one product, which just in this quarter alone, the last 3 months, they have added 643,000 new members, which is massive. And when somebody uses one product service, they're very likely to start using other product services. So that is pretty much, if they market one service like personal loans and somebody does take a personal loan, they're inclined to do other financial things and products and services through SOFI. So in 2020, 2021, SOFI reached highs of $24 per share, and it is now way down 65% from the all-time highs, and has not been recovering at all, while the underlying company has been growing like crazy. And it might seem like they're not profitable, but they have been profitable for the last 3 quarters, and they will continue to be profitable. And if you look over here, in 2024, they're expected to add 800 million to 1 billion of tangible book value growth. And the main thing I wanted to show you guys is the GAAP net income of 175 to 185 million. So this company has made the cross to being a profitable company, and I don't think they will ever go back. Congratulations, guys. You made it to the last stock of the video, the last industry of the video. And this is a sad voice because it's a very sad theme. Cybersecurity. And this is a difficult one. So we can see right here, the damage from cyber attacks will amount to $10.5 trillion by 2025, a 300% increase from 2015 levels. So the cybersecurity attacks are growing much faster than the cybersecurity segment is, which is a 12% CAGR. So it is growing 12.4% annually, and it is trying to put an end to cybersecurity attacks, which will never happen. Cybersecurity attacks have been growing, and they will only keep growing. And it is a very difficult problem to deal with. We can see that 98% of the cyber attacks involve tricks and manipulation. So these things are very hard to read. And with the advancement of AI that all these companies are using, it is getting better and better. But just lately, we heard that Microsoft has gotten hacked. A bunch of car dealerships got hacked. I live in Canada, and London Drugs, one of the huge retail stores, was hacked. And the Russian hackers demanded $10 million or $20 million. And this is just a growing problem. So investing in cybersecurity is, I think, just like I feel good about doing it. So if you take a look over here, this blog, the analysts are projecting for the cybersecurity market go from 200 billion to 560 billion by 2030, CAGR of 14%. And it also pointed out some companies that are in the cybersecurity space, such as IBM, Microsoft, Palo Alto Network, Broadcom, and others. So this is the one place that I've really struggled with, is finding the right stock to invest in. So one of the best things that I found, the best ways to invest in cybersecurity is ETFs. So XLK, ticker symbol XLK, is an ETF that holds 21% Microsoft, 19% Nvidia, some Apple, some Broadcom. Broadcom is big into AI, semiconductors, and cybersecurity. And they have just made an acquisition of $69 billion to buy VMware, which is a cybersecurity company. Now, there's a couple other ETFs that we're going to go through, starting with Hack. Hack owns Broadcom, is the largest holding. 9% of their ETF is in Broadcom. They also own Palo Alto Networks. They own Fortinet, CrowdStrike, Cloudflare. So this is a pretty well diversified and very niche, because most of these companies are doing just cybersecurity. So that is a good way to benefit off the cybersecurity. Two more ETFs that I'm going to show you, then we're going to get into the individual stocks themselves. So Cyber, CIBR is the ticker symbol. It is an ETF holding, again, Palo Alto, Broadcom, Cisco Systems, CrowdStrike, Fortinet, Cloudflare. So if you do not want to do the research of finding the best individual stock, it is better to invest into these ETFs holding more than one stock, so you'll benefit from each and any of them rising, really. And again, BUG, ticker symbol BUG, BUG, is the last ETF we're going to be going over. They hold Zscaler, Gen Digital, Fortinet, and you can read it for yourself. Now, I'm not going to tell you guys that this is the best stock or that is the best stock in this industry, because I really don't know. Full disclosure, I do not own any cybersecurity stocks. And going over them, I found red flags and flaws in all of them. So there's no perfect stock, or at least not in this industry, not yet. But some of the great things about investing in cybersecurity is they have great profit margins. So these are all tech stocks. So we can see at looking at some of these stocks, they have gross margins of 77%, 75%, 80%. And then Avgo, Broadcom, has the gross margin of 64% and net margin of 10%. So the company is huge, and they're not only a cybersecurity company, they are a semiconductor company, AI company, and then cybersecurity is in the third place. They do pay a dividend of 1.5%, which is 51% of their cash flow and 180% of their net income. So I don't really understand why they have this dividend. I believe they can use this money to grow the business in other ways than just losing money to pay us a dividend. But we can see that they are very cash flow positive. They are cash cows in a way, producing in the last year $17 billion in free cash flow. And I understand they want to reward it to shareholders. I have not done that much research, so I might be wrong. And if you guys do know what your favorite cybersecurity company is, please let me know, because I would love to dig into it. CrowdStrike, of course, I believe this is the most popular cybersecurity company. They are tied with Amazon, doing a bunch of cybersecurity for Amazon, and they have a little bit of a different model than all these other cybersecurity companies. They have all in one package, so you get all their cybersecurity services together in one package. That's about it. So the things that I like and don't like about this company is we can see that they have a 75% gross margin and only 5% net margin. So this might not be a bad thing, because they might be doing a lot of marketing. They might be doing a lot of things that will benefit the company in the future and grow the revenues and whatnot with that money, instead of just making it a net margin and paying a dividend like Avgo or something. They do also have a very good balance sheet that we're going to go over. And if you look at the analyst projections, earnings is supposed to grow 493%, almost 5x in the following year. Revenue to grow 21%, which is above the industry CAGR of 14%. And then looking at the balance sheet. So they have a very good balance sheet, a little bit of goodwill, a little bit of intangible assets. Doesn't hurt. They have $4 billion in cash, and they have $4.3 billion in liabilities. So they almost have enough cash to pay off all of their debt, which is a pretty good thing. The main thing I don't like about the company is it's expensive. It's just expensive. Whatever way you look at it, it's selling at a price to earnings of 350. It's selling at a price to free cash flow of 54. It's selling at a price to sales of 17. And we can see that the price to sales 5-year average is 30, but the price to earnings 5-year average is 83. So I believe that these companies, the hype is real, and the hype is supposed to be there, because cybersecurity companies do need to grow, and they're crucial in protecting our assets as everything is going digital. But just the prices is too expensive. And that is not just for CrowdStrike. If you look at any of the companies, if you look at Cloudflare, which is a very interesting one, 77% gross margin, 6.9% net margin. They have $1.7 billion in cash and only $2 billion in liabilities. So they also almost have enough cash to pay off all of their debt. But again, they're expensive. And one thing that I really don't like about Cloudflare is the insider selling. So if you look at this, the CEO went from 21,000 shares to 10,000 shares. So he has sold millions and millions of dollars of his position, which is never a good sign. And why is he selling? Maybe because they're expensive. Because it is not because they're not projected to grow. They're projecting to grow their earnings by 3 times, revenue by 27%, EBITDA by 9 times, 900%. But they're selling at a price to cash flow of 160, 17 times sales. There's just no margin of safety investing in any of these companies. And as a value investor, I like to buy companies when there's a margin of safety, knowing that if it drops below any of this price, the price that it is, it'll just be dirt cheap. So I'll be way more encouraged to buy more of it. And that is just, there's no margin of safety in this industry. Palo Alto is next. So Palo Alto has a bad balance sheet that we're going to go over, but they do have pretty good margins. If you look at this, they have 75% gross margin and a 32% net margin, which is very nice. But if you do look at their balance sheet, 17% goodwill, 2% intangible assets. That's only 2%, 20% in assets that are just on paper that aren't worth anything. And if you look at their total liabilities, current liabilities, total liabilities, $14 billion. And how much cash do they have? How much cash do they have? $2.5 billion. So they do have not as an attractive balance sheet as all of these other companies, but they have a very good net margin of 30%. So I believe they will be able to fix this up. And let's see what their projected growth is. So revenue increased 16% on the last year, expected to grow 11% next year, below the industry average of 14%. The industry is growing at a 14% year over year, but their EBITDA is supposed to grow and their earnings aren't supposed to grow. Again, this, I guess, is a little cheaper of a company if you look at the earnings, only 42 times earnings, which is still pretty insane. And then let's go over one more company that we're going to go over. Cyber. We're going to leave Fortinet out. Fortinet is another company, has insider selling, has been around for 24 years. So check that out. Fortinet. Okay. Cyber attacks, CyberArk software. So the growth has been insane, grown 30% revenue over the last year, has a lot more cash than liabilities. So it has a nice balance sheet. We can get into that. Gross margin of 80%. So a very nice gross margin, but again, a negative net margin. This company has $1.4 billion in cash and liabilities of only $1.2 billion, giving it a pretty nice ratio. 1.4, I don't know about that. I do know they have 1.4 billion in cash and 1.2 billion in assets. And if you look at this, revenue is supposed to grow 22% over the next 12 months. Earnings per share is supposed to 8x, 800% over the next 12 months. And EBITDA 4x over the next 12 months. Trading 67 times free cash flow. So that is just one thing that I'm really struggling, is to find an attractive price in one of these cyber companies. Cybersecurity companies, and that is why I'm more drawn to investing in ETF, holding more of them, so I'm more diversified. Tell me what you guys think. And one thing I do like to point out is that it is September. It is September 9th right now, and September is known to be a bad month for the stock market and for the crypto market. So I'm really hoping that everything just crashes so we can get some discounts, guys. And let me know what you guys are buying. And I hope this video helped you guys out. And thank you guys very much for watching. Please check out the video for SOFI if you're into SOFI. Watch Daniel Prong for the Berkshire if you want to invest in Berkshire. And tell me what cybersecurity companies there are that are attractive, because I have not found any yet. Thank you guys very much for watching, and have an awesome day, guys.